Welcome to the Private Lenders Podcast with your host from Hard Money Bankers, Jason Balin and Chris Haddon. This podcast is sponsored by hardmoneymastermind.com.
Hey everyone, welcome to the Private Lenders Podcast. We appreciate you checking out the show. Today, we are going to be answering some questions from the Mastermind group. If you haven't seen the Mastermind yet, go check out hardmoneymastermind.com. All right, we're going to dive into a few recent member questions. Which one do you want to start with?
Let's talk about insurance for private lenders. Some insurance policies that, as a hard money lending company or a private lender, would be, smart to have. Some of them are pretty inexpensive. Some of them can be expensive, right? So it might be something that you want to scale into. We're not talking about title insurance. We're not talking about, individual property insurance that that builder's risk insurance on your clients. Just like insurance policies that, you as a small business owner should potentially have or need.
Yep. Yeah, let's go through some of the basic stuff. Like, we have a couple policies that any business would have, like liability for the office, right? It is helpful to talk to a knowledgeable insurance broker, and the guy who we use, he's knowledgeable across the board. Like, he knows about all kinds of different policies. He's a very good resource. So yeah, basic insurance on the office and whatever other liability that covers. By law, we have to have workers' comp insurance, so we have that too. Those are two kind of basic ones. We have a company truck, so obviously there's auto insurance on that, all on the business level, all handled through the same broker. And then the next step up, and this has been talked about a lot recently in the Mastermind group, is that what do you do when your borrower's insurance on their properties, the property insurance, fire insurance, hazard, whatever you want to call it, lapses, or you don't have proof of renewal or something like that? How can you handle that? So one way you can handle that is you can pay the existing policy on their behalf as the mortgagee and renew it through whatever insurance company they're using. So like that's a good strategy. It's a fine strategy when you just have a few loans outstanding, 10 of them or something like that, where you can easily track insurance. And at that scale, you're not going to have too many policies lapse. But later on, and this is what everybody's in the masterminds are getting into, at what size do you want to have your own kind of force place line? You want to talk a little bit about how a line that works?
I don't even know public, since this is a public podcast, I don't even know if it's compliant to even pay for that policy to renew it on behalf of your client. Maybe it is, maybe it's not. That's irrelevant. But I do know that you can get a force-placed policy, a one-off force-placed policy.
Yeah, an individual one. You're right about that.
Chimed in and tried it and said it was a nightmare. And we did a presentation with the guys at Lee & Mason, mortgagehazard.com. If you want to check out their website, that's who we use. If you want the direct contact, just hit us up in the mastermind group and I can give you that. But yeah, and it's free for them to set up, and then they don't pay until you actually have a property that you put on the line. But in essence, it's just a force place lender place line. If there's an uninsured property, you go onto their website, you add in the details, address, what type of do you want builder's risk, do you want flood, do you want vacant, whatever the case is. At that point, the hazard component, actually I don't even know if it's builder's risk, I think it's just hazard. And they charge you on a per diem basis, per day basis, not a year policy, month policy. It's how many days that's in place. So that's been a popular topic that's come up as well. And doesn't matter what size your portfolio is, it's something to definitely consider, because that will happen. And that's one of those things that it's like, oh shit, like I need insurance on this property. There's only a few ways in this space that you could really lose big, and lack of insurance and big loss could be one of them.
Yeah, and they make it like Jason said, we use mortgagehazard.com, and they make the process so much easier than actually going back and forth with an agent about getting a force place policy or renewing a borrower policy or something like that. It's a very easy interface where you can just add and remove addresses as you need, right? Loan pays off, remove it. You're not getting proof of renewal, add it on there. It's very quick and easy. You don't need to go back and forth with any rep or agent or anything like that. It's just all through the platform. And there's even some good things. They let you backdate it if you need. And also if you add a property to the line and then a week later you get the renewal information from the borrower and you're like, oh shit, and they will not charge you for that, right, if it happens within a certain window. So there's a number of helpful aspects to that line and that platform.
Yeah. So next up is like a commercial liability policy that you have, and the in essence, kind of like an E&O. I don't even know if it's technically that or not. There's not many governing regulations for this space, so it's hard to find that an exact policy. But in essence, through some insurance brokers we've worked with in the past, they've written a kind of just a commercial general use business liability policy where we can kind of go in and pick and choose what we want based on our size of our portfolio, cyber fraud or cyber theft, I should say. I'm trying to think what other stuff is in there. Bit accidentally sending money to the wrong person, things like that. If there's any an employee messes up, so things like that are in there. The problem is it's expensive. It's like $25,000 a year. So a lot of people, and that's not fully covering everything. Very, very high deductible. We try to do it based off our medium type of loan type, and it's like worst case scenario loss type of situation.
Yeah, it's the kind of policy that you want to never have to use. The goal is to never have to use that policy. It's something really bad has happened if we need to pay that deductible and try and have a claim paid on that policy. So obviously the goal is to never have to use that, and we just kind of bear the cost of in case something bad happens. All right, that's about it on the insurance topic, right?
Yeah, let's move over to a question of, hey, related to, do you have any processes, even tips and tricks to add to and building up your personal investor account inside HMB? And how does that look if you're not using some of your co-lenders? And Chris and I might have a few different things that we're going to add to this. But listen, in a perfect world, we do like $50 million a year. If we could do that our own with all of our own funds and not other co-lenders, that'd be great. We're not at that position to do that yet. And, we'll see what happens with the business kind of in the future. But the important part to understand is this is an investment vehicle for yourself. And that's the way that this hard money lending model is set up, right? If you're lending out at say 13-3 and you have co-lenders involved in your deals, and let's say you make a servicing fee of 3% and they're getting 10%. If you do the math over a 6-month term, you're splitting everything 50-50. You're keeping the points, you're keeping some servicing fee, maybe some other miscellaneous fees. They're getting their 10% return annualized, which ends up being 5% in 6 months. You guys are both splitting it 50-50, which is fine. Someone co-lends, puts up the capital, you're doing the heavy lifting. Nothing wrong with that. But imagine if you were the actual lender on every one of your deals, you'd be making twice as much money. You either make twice as much money or you do half as many deals and make the same amount of money. Any way you look at it. So we're well aware of that very early on. We realized that like year 3, when one of our co-lenders was making substantially more money than we were, and he was only involved in a few deals. So we realized like, hey, let's take out the minimum amount that we can take out on a regular basis, because we're very, this is the business model that we put the majority of our money into, the investment vehicle. We put the majority of our money. Not that we don't diversify into other things, but we're very passionate and understanding we put our money where our mouth is. So we, take out kind of the minimal amount that each of us need, and the rest of that we put into individual co-lender accounts. Could we do it on a company level since both of us just split it anyways? Yeah, we do that as well, but not a substantial amount. But individually, we each have our own co-lender accounts, and then all the companies have lender accounts as well. And a real quick, easy hack, and then I'm kind of stealing the show, and then Chris can hop in and talk as well, is
No, it's all good.
auto debit thousands and thousands of dollars a month from our business accounts to go into our business co-lender accounts. And that's just been a very easy passive way to grow those accounts over time.
Yeah, it does add up over time, and seeing those deposits go through every month, and it just moves from the operating account to the account and right into that company's lender account. So that's been a good one. And then, yeah, backing up to the initial question that came from Shelby inside the mastermind. So, all right, two sides to it. On one side, a lot of people get into this business later in their career because they've accumulated a bunch of capital and they want to earn a good rate of return on it, and that's awesome, right? There's a lot of people that we know that are in that exact position. If you start earlier like we did, you might not be in that position. So we started this company and we were, I think, 27, and we're in our 20s. We were getting started with our career. We didn't have a lot of investable capital yet. So that's where the, co-lenders and everything came in. And then over time, we were into it. It's you know, it's not the most fun. It gets fun later on, and consistency is key. Like we would do when we would take distributions, like Jason said, we would take less than what we needed so that we had funds to put over into our lender accounts, and that would happen both monthly and quarterly. And like we had a system, we still do have a system quarterly where we let the servicing fee accrue. We don't take those out in distributions, and then we take it out at the end of the quarter, and that's also when estimated taxes are due to the feds, right? So you pay your taxes, and then we put the rest in the lender account. Pretty simple but effective, right? And then over time, it becomes a real number. But trust me, I understand that it is a long, slow, and painful process, but it's the only way to get there. Just like retirement investing, right? Like you got to start early, you got to start small, and never stop. That's the only way it works. But you fast forward the time, and then those numbers start becoming real, and then you're in a good spot, and then the interest that you're earning from your lender account starts becoming substantial and a good slice of your overall income. So I hope that answers the question. I think that
Yeah.
yeah.
Well, and also it was the other good takeaway from that is, divvy up the different income buckets between the front end stuff and the servicing stuff instead of commingling all that together into one and then dispersing whatever, and just organize it that way. Say, hey, everything that comes from this particular fee I can use for, operating costs, marketing, payroll, rent, stuff like that, business rent. And then the other stuff I use, for taxes, the other stuff I use for, reinvesting in my lender account, however you want to get with it. All right, let's do one more question. The next one was, and we'll expand on this a little bit. The question came in: do any private lenders here balance sheet long-term debt? We don't, but I do think there's a need for it. And
Good
I think
question.
depending on how your capital's set up, if you wanted to do it, it's not the end of the world if you structured it accordingly. There's certainly not necessarily on the investment residential side, but on the commercial side, they'll do longer term paper, 5-year, 10-year, 15-year, maybe even longer. It just depends if you want to do it that way and what type of returns you're trying to achieve. So like we try to do everything short term, typically within a year. We can make the rate of return that we want, 13 and 3. Sometimes the money turns more than once a year, maybe it doesn't. But it also gives us the ability and the flexibility if the markets change that we're only into these things for a year, assuming if they can exit the loan. And then we can determine what to do, after that. Do we have loans on our books that have been outstanding for a longer period of time? Absolutely. We just try to go into them shorter. And typically what I'll tell people, mostly on the commercial side, is, hey, listen, if you want to do something longer term, we'll do it year by year. And at the end of the year, we can write some sort of extension modification, maybe repay the points, and then we can keep it going. And, sometimes we write that to our note. Sometimes we do it on, verbal. Sometimes we write it in the note. But like, if you're in a position where you want to do, let's say, a 5-year loan, I wouldn't do that on like a fix and flip, right? Like you don't want to give somebody more time just because, like, nobody wants to pay a 13% interest rate for a
Right.
long period of time, right? So it's got to make sense in that situation, but let's say somebody owns $1 million commercial property and they need like 200 grand and it's cash flowing, and maybe their credit's lower and they're not going to get out of it in a year. And you don't want to put them into a situation where they're going to just get foreclosed on type of thing. Maybe do a 5-year loan. It can still be interest only, knowing that it's just going to be outstanding for a longer period of time. And if you want, you could do and you could amortize it if you want. You could also do principal reduction every renewal, right? So it's like every year, pay down, an extra 5% or 10% of principal as a renewal. And the good part about that is every year, you're reducing your risk because your exposure is getting decreased because they're paying down principal. So that's another strategy that we like doing. And, and if you're like, hey, I'm in at a 20 LTV, the market's not going to ever get that shaken up, I'm good. That's okay as well. As long as your capital on the back end is okay with, committing to stay on the, outstanding that long as well.
Yeah, I will add in too that we dabbled with doing 5-year loans and amortized. I forget what the amortization period was, but I know it's a 5-year term on residential rental.
They would pick the amortization cycle. We could do it up to 20 years.
Okay. We dabbled with that on residential rentals, and it was not a great setup. It wasn't great for the borrower. The loan amount has to be low in order for it to still cash flow with a 12.99 rate on the debt. And it wasn't great for us either. Like, we're not really set up. I mean, we are set up with loan servicing system to do amortized loans, of course. It does that fine. But we as a company didn't totally love the amortization and the principal coming back each payment and what that did to like account balances and stuff like that. It just wasn't, we didn't like it. Our co-lenders didn't like it. The borrowers didn't really need it. And so we killed that after a short amount of time. Maybe we did that for less than a year and backed out of that one. So yeah, I mean, private loans can be longer term in the right setup, like Jason said. But yeah, go about it thoughtfully and make sure it makes sense for the borrower and for you as the lender, what the loan amounts need to be, what the cash flow needs to be. And then, yeah, I mean, there are commercial lenders especially that do some longer term stuff. And there's definitely nothing wrong with that. I mean, it's nice to be able to grow the portfolio. Like when you do short-term loans, 12-month loans, you constantly have to do new ones because the other ones are paying off. So I do understand the value of growing a portfolio by having longer terms. Anything else to add, or is that the pod for today?
No, I think we're good. If you haven't checked out the next live event, it's in June 4th and 5th. Go to Hard Money Mastermind event.com. We already have a lot of lenders signed up, but there is a few more spots, and it's the first time that we're actually doing this summer event, this June event. And it's actually going to be, I'm pretty excited about it because it's not just going to be a mastermind segment. And there's also going to be a good bit of education. We each have a few presentations, to talk, to go through. There's going to be the mastermind component. And we also have some local vendor service providers that have been helping us, along the way as well, come in to speak and do presentations. So I'm certainly excited about that. It's June 4th and 5th near our offices in Maryland. So if you haven't checked that out, just go to hardmoneymastermindevent.com.
All right, everyone. That's the pod for today. We'll see you here next time on the Private Lenders Podcast.
We hope you enjoyed this episode of the Private Lenders Podcast. Please note that the opinions stated by all the speakers on this show are only opinions and not intended for legal, financial, or accounting advice. Please make sure to always check with your own legal, accounting, and financial professionals. If you enjoyed this episode of the Private Lenders Podcast, we'd appreciate it if you would spread the word. Make sure to check out hardmoneymastermind.com, the #1 free community for new and experienced private and hard money lenders.